That's a concentration of power that we haven't seen in private hands ever, or certainly not in modern times. I mean, yes, we've had fintech innovations where they cut out the traditional banks to give us cheaper and faster services. But this is not disintermediation. This is re-intermediation, and on an unprecedented scale. They are effectively inserting a corporate giant where the banking system and even the sovereign monetary system used to be. And honestly, I think this should make anyone nervous. Hello, everyone. Welcome back to another episode of GRC in Focus. I'm your host, Asad, and today I will look at how stablecoins are transforming major corporations from mere users of money into creators of money. And importantly, what does that mean? So let's dive in. Companies with combined revenues exceeding $1 trillion, think Amazon and Walmart, they're talking about issuing their own USD-backed stablecoins as core infrastructure for their global ecosystems. Now, just to put this into perspective, for the past century, creating money has been the exclusive domain of central banks and well-regulated financial institutions. I mean, yes, we've had what you call company scribs and loyalty points, etc. in the past. But these were, I would say, glorified coupons at best. They were not real currency, and they had very limited utility. But what's happening now is qualitatively different. You have major corporations preparing to issue digital money substitutes that could have utility equal or even greater than traditional national currencies, but within their own ecosystems. Now, why would a retail giant like Amazon or Walmart even want to issue its own stablecoin? I think the answer is quite simple. I think it's margins. You have all these payment intermediaries today that take a bite out of these transactions. If you look at Visa and MasterCard, for example, they tend to charge merchants anywhere between 2 to 3% on each credit card sales. If you are a low margin, high volume business like, say, Walmart, that's doing upwards of $600 billion in annual revenue, I mean, these charges, they add up. And in the case of Walmart in particular, we're looking at $19 billion. Now, if transactions within Walmart or Amazon universe were to use, let's say their own proprietary digital token that's backed by good old US dollars, those interchange fees could be eliminated entirely. And that would be a massive boost to their bottom line. But it's not just about the cost savings. When you issue your own money, you suddenly control the entire payment ecosystem within your commercial environment. So you're not just selling stuff anymore. You are effectively running a whole financial system. And this means you are able to give your customers instant and practically free transactions. And you can embed loyalty rewards directly into the money. Talk about programmable cash. And you get total visibility into customer spending behavior within your domain. Every single purchase that's made with Amazon coins, for example, that would allow Amazon to capture and analyze that data fully. And that's, way more than they would ever get from any external card payments. Now, think about what Apple did with its App Store. If you use their in-app payment system, Apple is at the center of every transaction. So it's pretty much the same idea, but for all your money. A corporate stable coin means your money stays circulating within their universe. So imagine Amazon customers holding Amazon tokens. They can use them for everything, shopping on Amazon.com, getting groceries at Whole Foods, paying for AWS subscription, maybe their Prime subscription as well, and maybe even buying from third-party sellers on Amazon's marketplace. The more places that you can spend Amazon coin, the more useful it becomes, and the less reason you have to convert it back to traditional dollars, right? So this is a very strong network effect where every new use case is strengthening the tie between you and their ecosystem. So Amazon or any company that can nail this would essentially achieve corporate sovereignty within its own empire. If customers are holding millions of dollars in Amazon coins, Amazon gets to earn interest on the dollars backing these coins until redemption, pretty much like a bank, but without all those pesky regulations. But what happens when these corporate giants start coining their own money? When you think about it, when Amazon or Walmart can issue their own currency, they're basically doing way more than just saving a few bucks on payment fees. They are effectively creating a sort of closed loop systems where the corporations control both the money and the marketplace. And I think this is a fundamental shift in economic power that's very, very different from any loyalty or gift card program that we've ever seen. We're talking about corporations with GDP-sized revenues potentially dictating monetary policy within their own ecosystems. So they set the rules for how their currency works, how it's issued, how it's redeemed, and maybe even the value. Although I would hope that if it's a true stable coin, the value should always stick to $1. If you think about antitrust implications, if Amazon coin or say a Walmart coin becomes widely adopted, these companies effectively become the central bank for a huge chunk of e-commerce or retail. So they'd be able to control the money supply, they'd be able to control the transaction validation, and they'd also have access to all that economic data. That's a concentration of power that we haven't seen in private hands ever, or certainly not in modern times. I mean, yes, we've had fintech innovations where they cut out the traditional banks to give us cheaper and faster services. But this is not disintermediation. This is re-intermediation, and on an unprecedented scale. They're effectively inserting a corporate giant where the banking system and even the sovereign monetary system used to be. And honestly, I think this should make anyone nervous, because history is littered with examples of what happens when institutions get too big to fail or they wield too much economic influence without proper checks. And I worry that with corporate stable coins, if they take off, we could very well end up with regulatory capture, where you have a bunch of these corporations that gain so much clout that they end up writing the rules that govern them. Now, remember, not too long ago, we separated commercial banking from central banking for good reasons. And that was basically conflict of interest, prevent conflict of interest and massive power grabs. And I think corporate stable coins blur that line again. And I worry if that's left unchecked, we could very well end up with a situation where effectively you have a bunch of CEOs and their boards that could have more say over the flow of money than actual central bankers. And I think that should make anyone who cares about financial stability and fair competition nervous. Now, there's a more ground level aspect to these captive corporate economies that I think we need to talk about. That's the power dynamics. Let's say a company's stablecoin becomes the only way to transact in its ecosystem. So effectively, participants are stuck because they have no other choice but to use it and to use it on the company's terms. So the power dynamics, I think, can become grotesquely asymmetric. Imagine you have suppliers being pressured to accept payment in a corporate token just to keep doing business. Those suppliers could very well end up holding huge balances of these tokens. That effectively makes them become unwilling creditors to the company, because while they are holding on to the tokens, the corporation earns returns on the dollars that's backing them. So this is effectively a new form of supply financing that sits completely outside of traditional banking regulations. Think about what that actually means. You have suppliers holding corporate stable coins that are essentially giving the issuer an unsecured interest-free loan. all while bearing the operational risks of the token system, like technical glitches or redemption delays, etc. But meanwhile, the corporation rakes in the float, the interest on the reserves, and they get all the payment data as well. But the burden of the working capital shifts onto the little guys, the suppliers who have to sit on piles of tokens instead of actual dollars just to be able to play the game. I mean, that's a fundamental shift in how credit and liquidity move through a business ecosystem. And frankly, I think that's very problematic. I suspect this could trigger a race to the bottom. If you have one retail giant that starts extracting financing advantage by running its own currency, I think competitors are going to look at this and they will feel, a pressure to launch their own tokens just to keep up. And I think we could very well see a cascade where corporations use monetary issuance as a competitive weapon. So forcing widespread stablecoin adoption, not because it's inherently efficient, but because no one wants to be the only one who's still paying 2 or 3% to Visa or letting others pocket all the float. So the real risk here, I think, it's business decision stops being driven by product value or economic efficiency, and it starts being driven by this currency competition. I think in the long run, this could destabilize the entire system and create a feedback loop that we can't even begin to understand yet. I think these are precisely the second order effects that boards need to consider. It's not just about, can this save us money on transactions? We need to be thinking about, are we creating a closed economy where we hold all the power and everyone else has to bow down? And if so, what happens if that model implodes? I think asking these tough questions is part of the fiduciary duty in this new world of corporate money. Now, you might be thinking, well, surely regulators won't just let Fortune 500 companies start minting their own money without a fight. And I think you'd be right, partly. We've just seen in the US proposals like the Stable Act and the Genius Act that just passed on the 17th of June with a bipartisan vote of 68 to 30. These were designed to stop large tech or retail firms from directly issuing stablecoins. Policymakers had valid concerns about unregulated private money, and so these bills were intended to put in place some guardrails. But if history teaches us anything, corporate legal teams are very adept at finding loopholes. And I think in this case, the loopholes are very obvious. So even if the law says big retail companies can't issue a stable coin, there are so many creative workarounds. I can think of, for example, partnership arrangements where you have a financial partner or consortium technically issuing the stable coin, so not the company itself. Or you could have subsidiary structures where you have a separate legal entity under the corporate umbrella that issues the token, so that keeps the parent company one step removed. The other option, of course, would be white labeling, where you have a regulated financial institution issuing the stable coin that's simply branded for the corporation. Now, any of these structures could achieve the same outcome. So the stablecoin is fully integrated into the company's ecosystem, serving its strategic goals without the company having to be the issuer on paper. And let's be brutally honest. I mean, we know legal departments in major corporations, they are often 10 steps ahead of regulators. They will exploit every ambiguity and they will push right up to the very edge of what's allowed. One new stablecoin project from a fintech affiliate of a corporation, let's just call it USD1, they proudly tout 100% backing by short-term US Treasury securities and cash equivalents. Now, this might sound very safe, but when you look in the fine print, you look at the definition of cash equivalents, it's deliberately vague. And so I think this kind of structuring tells me creative reserve accounting is to be anticipated. I think they are leaving the door open to slip in assets that technically fit the definition, but might introduce more risk, like certain types of commercial paper or even some crypto assets under a loose definition. And to me, that's a clear signal. It's a signal that even where the rules exist on paper, like, back your coin 1-to-1 with safe assets, the reality might be fuzzy. And so, from a governance perspective, I think this is a massive red flag. Legal loopholes and regulatory gray zones mean the true risk profile of a corporate stablecoin could be totally obscured. A company could claim full backing and compliance, but they could be hiding risks in how they manage reserves or how they actually issue the coin. And the problem is, once a corporate stablecoin gets big enough, I think regulators might find it politically impossible to crack down, because if you have millions of consumers, let's say, they're using Amazon coin, will a regulator really dare to ban it and face a public uproar? So this dynamic, I think, can lead to a de facto regulatory capture, where by the time the rules catch up, the horse has not only bolted, but it's grown into a freaking unicorn. And we've seen this dynamic before, where new innovations scale faster than regulators can respond. And by the time authorities realize that something needs oversight, that thing has become systemically important. I think corporate stablecoins could follow that same path, rapid adoption, creating a situation where strict regulations after the fact is not only economically, but also politically a non-starter. On the flip side, some regulators actually see stablecoins, even corporate ones, as potentially beneficial if they are properly regulated. There's a geopolitical angle here. US officials, for example, have openly stated that a thriving stablecoin ecosystem could bolster US dollar dominance globally by driving demand for treasuries, which back those stablecoins, and also exporting digital dollars abroad. So the regulatory stance, I think, will have some rules that are aimed to harness stablecoins for national advantage, while you'll have others that try to curb corporate power. Companies, I think, will struggle to navigate this patchwork, but I think it also means there are opportunities to exploit, and those who can exploit that, they will exploit that fully. The bottom line here, I think, is, don't assume that a corporate stable coin that's operating in a gray area will stay there forever. I think laws can change in a heartbeat, and what's allowed today could very well be outlawed tomorrow, and vice versa. So you should keep your eyes glued to those evolving laws. Now, one of the big selling points for corporate stablecoins is the complete data visibility that they offer to the issuer. Every single transaction in a corporate token is traceable on a ledger. And if it's a company-controlled ledger, the company has full access to that data stream. So from a business perspective, you can see that this is pure gold. I mean, imagine knowing every single purchase your customers make within your ecosystem, what they buy, when they buy, how often, in what combinations, and never having to rely on limited data from banks or card networks. The company can analyze and monetize this information in endless ways. Think targeted marketing, dynamic pricing, product development, credit decisions, you name it. But from a governance and compliance angle, this screams privacy and surveillance. We often hear concerns about government-issued digital currencies, so CBDCs, that would enable state surveillance of citizens' spending. But ironically, a corporate stablecoin could create a private sector version of that surveillance state if it's not kept in check. The corporation could, in theory, choke certain transactions that it doesn't like, or it could favor certain behaviors because it has absolute visibility and some degree of control over the currency. Of course, companies will swear that they never do that and that customers can trust them, but consider the incentives. I mean, let's say the data shows, for example, that users who buy certain combinations of products, they are more likely to churn. So the company could intervene in very subtle ways. I mean, they might not outright block purchases like an authoritarian government with a CBDC would, but they could start manipulating the user experience, maybe by adjusting recommended items or maybe even offering special incentives to steer behavior. The point is, having that much of data and power concentrated in one company's hands I think that raises serious ethical and compliance questions. So, are we really okay with essentially allowing corporations play big brother over an entire microeconomy of its users? I think for boards that are overseeing a company rolling out a stable coin, robust governance frameworks are absolutely essential to prevent the abuse of this data advantage. We need to ensure these stablecoins don't accidentally turn into financial surveillance that would harm consumers' privacy or create unfair competitive advantages. There needs to be clear policies for how transaction data is used, how it's stored, and how it's shared. So it's important that if you're a board member, you're asking the hard questions like, is it strictly siloed for improving user experience, or could it be sold to third parties? Will users have any choice or visibility into how their spending data is being exploited? I think these questions fall squarely within compliance of data protection laws and ethics. And remember, trust is the bedrock of any currency, corporate or otherwise. So if users start feeling that using a corporate coin makes them vulnerable to profiling or discrimination, they'll push back. And regulators might also step in. Imagine a future where your Amazon Coin wallet data is being used to determine your eligibility for an Amazon loan or service. And they go, sorry, you spend too much on fast food, not enough on books. Our algorithm flags you as a higher credit risk. That kind of cross-utilization of data blurs the line between commerce and finance in ways that perhaps society might not be ready to accept. But I don't think that's far-fetched. I mean, we already see how social media data or e-commerce purchase history can feed into credit scoring algorithms. And I think that a closed loop monetary system would supercharge that trend if clear boundaries are not set. In short, stablecoins, I think, present a major surveillance dilemma. They give the issuer total transaction insight, which I think can drive efficiency and personalized services, but it also creates huge privacy risks and the potential for misuse. Boards need to understand how these data powers will be governed. So you need to be asking management what governance frameworks are in place to ensure our involvement in a corporate stable coin doesn't support Orwellian surveillance or unfair market power through data. You need to ask for concrete plans about anonymization, data security, and oversight of data-driven decisions in these ecosystems. And this can't be an afterthought. Now let's talk about the systemic and operational risks of corporate stablecoins. In traditional finance, we fret over things like credit risk, liquidity risk, operational risk, market risk, etc., etc. Now, all of these exist here, albeit in new and concentrated combinations. Let's take credit risk. With a regular bank deposit, your risk is that the bank fails, but deposits are often insured, and banks are heavily regulated to manage that risk. Now, with a corporate stablecoin, the credit risk extends to both the issuer and the assets backing the coin. So let's say Amazon issues Amazon coin and backs every token with a US Treasury note. So you might think, okay, no credit risk because, treasuries are safe. But imagine if Amazon itself hits a major business crisis, let's say a huge scandal or market share collapse or whatever. And as a result, they are facing a cash crunch. Amazon might need to liquidate those backing assets to raise cash for operations. Now, normally, stablecoin reserves would be untouchable for anything but redemptions. But if it's Amazon's own money and Amazon is in trouble, I mean, who's to say that they wouldn't tap into those reserves or that holders wouldn't rush to redeem, knowing that Amazon is distressed? So suddenly, your stablecoin is tied to the corporate credit risk of its issuer. The value might still be $1 in normal times, but confidence could crumble if the issuer is on the ropes. I think this correlation between a company's financial health and its currency's stability is new territory. Look, your dollar bill won't disappear because Walmart or Amazon had a bad quarter, but an Amazon coin or Walmart coin might face that exact feedback loop. Now let's talk about liquidity risk. Even if the backing assets are ultra safe, like, say short-term treasuries, there is the question of liquidity under stress. If multiple big corporate issuers all have stable coins backed by treasuries, which is highly likely because, what else would they use for stability? We could end up with massive concentration of reserve assets. Most corporate stablecoins will hold similar asset pools, so primarily short-term government securities, which means many issuers are exposed to the exact same market factors. Now, if interest rates go up, or let's say treasury market has, some hiccups, those reserves could suddenly experience unrealized losses or liquidity constraints at the same time. Now, even worse, imagine a scenario where several corporate stablecoins face a huge redemption pressure simultaneously. Say, there's an economic shock or, just a loss of confidence that causes users to cash out their tokens for dollars. Those issuers would need to liquidate reserve assets, i.e. treasuries, to meet redemptions, just as they might also be struggling with their own core businesses due to the same economic shock. So the result could be a fire sale of treasuries by multiple massive corporations all at once. And that could put a huge strain on credit markets. So essentially transmitting corporate distress into the financial system via stablecoin reserves. This is a domino effect that traditional central bank money doesn't trigger. And this is why boards need to ask, have we modeled scenarios where multiple corporate stablecoin issuers face simultaneous stress and redemption demands? And how could that hit our broader portfolio, fixed income, credit markets, etc.? This is systemic risk that requires stress testing across firms, not just within one firm. There's also this inherent incentive for stablecoin issuers to reach for yield on their reserve assets. Running a currency is not free. You need to think about operational costs. You need to think about the tech infrastructure. You need to think about compliance, all that jazz. So how do you pay for it? One way is to earn a return on the assets backing the stablecoin. We assume they will keep reserves in safe assets. But even within safe assets, there's always that temptation to take on a bit more duration or a bit less liquidity to squeeze out extra yield, just like banks sometimes do. This is where concerns about a potential backing asset Ponzi dynamic creep in. If big companies start issuing billions in stable coins and plowing the proceeds into treasuries or similar assets, they effectively become huge leveraged players in those markets. They need those assets to stay liquid to meet redemptions, but they also want to maximize returns on them to make the stablecoin business profitable. That creates incentives for duration mismatches. So investing short-term liabilities into longer-term assets, taking on some credit risk, or otherwise transforming liquidity. Those are exactly the ingredients that led to the 1980s savings and loans crisis, or more recently, some of the DeFi stablecoins that failed whilst chasing yield. The worry is that when corporate performance deteriorates, say, because the company hits a downturn, stablecoin holders might all redeem at once, right when the company also needs to sell assets for its own needs. You end up with a procyclical double whammy. This means corporate credit risk and monetary stability risk become correlated in a way that we've never had with traditional money. So it's a whole new species of risk. Let's not forget that running a digital currency platform is a massive technical undertaking. Even crypto-native stablecoin issuers have suffered occasional hiccups. So for a corporate issuer, assume that the challenges are going to be tenfold. So, think smart contract bugs, relentless cybersecurity threats, blockchain network congestions, maybe Oracle failures if any external data feeds are needed. You need to think about key management, so securing the private keys that control reserves or issuance. But these are all inevitable operational realities that needs to be planned for, and they need to be constantly monitored. if Amazon's checkout, let's say, they use Amazon coin, goes down because there's a software bug, that's not just a minor IT issue. That could halt sales across the entire platform. And if hackers compromise the system, we could see theft or fraudulent creation of tokens, which would be catastrophic for trust. So I think boards need to be asking, do we have the operational resilience to run a quasi bank? How are we testing smart contracts? What's our standard incident response plan for, if there's a hack or a bug exploit? This also bleeds into compliance because as soon as you issue a stable coin, you trigger the requirement for robust AML controls. Now, these are areas where many financial companies, they haven't had to deal with before. Because when you make a purchase on, say, Amazon, they don't have a team there sitting and vetting every purchaser, right? Another risk dimension is ecosystem fragmentation and the glaring lack of interoperability. Each corporate stablecoin might run on its own rails or at least be a separate system. Monetary systems tend to be winner take all or winner take a few because of network effects. So we might end up with several competing corporate currencies that don't play nicely together. Imagine you have Amazon coin versus Walmart coin, where converting one to the other is intentionally made difficult or costly because each company wants to keep users in their own silo. The more these corporate currencies succeed, the more each builds walls around its network, which complicates any strategy to not have all your eggs in one basket. So in a nutshell, what I am saying is the risk landscape is complex. We've got credit and liquidity risks intertwined with corporate health. And then you also have concentration risks because many will use the same types of reserves. And then you also have the operational risks that's inherent to any blockchain-based system. You also need to think about the strategic risks from fragmentation. So it's going to require an entirely new risk management framework to address these risks. The usual stress tests and models that banks typically use, I don't think that's going to capture the scenarios like, what if our retail partner's currency crashes, or what if a bug freezes all token transfers for a day? So I think part of our responsibility is to push for those new frameworks and to not accept business as usual risk reports when we do venture into this area. Many countries are actively drafting laws specific to stablecoins. So authorities could very well decide that a corporate-run stablecoin system is actually an unlicensed bank or a money market fund, and they could shut it down, or they could push for a banking license. So I think investors need to factor that risk in, and it's important for them to understand what contingency plans are in place. For example, let's say, regulators decide that your stablecoin venture is against the law. So you need to think about whether you can exit or you can adapt quickly if rules suddenly change. I mean, we saw a version of that play out previously with Facebook's Libra project, which got reined in by regulators worldwide before it even launched. I think a corporate stablecoin could face even stricter scrutiny if its user base grows too big or if it's seen as undermining the local banking sector. Now, let's talk about the geopolitical angle. Corporate stablecoins, especially dollar-backed ones, can have massive international repercussions. When a US corporation's digital currency starts circulating in foreign markets, it effectively extends US economic influence abroad, but through private channels. So some governments might not be comfortable with that at all. Let's assume Amazon launches a dollar stable coin and it becomes hugely popular in a country with a weak currency. Suddenly, a large portion of transactions there shift into Amazon coin, which is dollar backed. That country's central bank and government, they face a huge dilemma. Do they allow a foreign corporate currency to gain dominance in domestic commerce, potentially eroding their monetary sovereignty? Or do they crack down and ban or restrict its use? So we could easily see political and regulatory backlashes abroad, especially in regions that I think are sensitive to US tech influence, or where US-China tensions make anything that's dollar related a geopolitical flashpoint. In fact, I think countries that are caught between competing monetary systems, say a Chinese digital currency versus a US corporate tokens, they may suddenly prohibit corporate stablecoins, even if they were gaining traction as a defensive move. And obviously, such an action would wipe out overnight the value or usability of a stablecoin in that market. And that would translate into losses or stranded assets for investors and the company. If an emerging market one day says, sorry, only our central bank digital currency is allowed and all foreign corporate tokens are illegal, that portion of the stablecoins circulation is effectively frozen or destroyed. So I think these are real risks that investors need to take into account. Now, we also need to talk about the diverging regulatory regimes across different countries, especially the EU, the UK, and the US. What that means is a company could very well be compliant in one jurisdiction, but it could find that another market is completely off limits. If a company is running a stable coin, it should be transparent about its reserves and its audit, but also its governance structures. And I think we as investors or board members, it's important that we mandate regular audited reporting on those reserves. Operational resilience should be demonstrated perhaps through third-party certifications. Basically, if we are treating this like a financial institutions, we should govern it like one with the same rigor. Regulators, for their part, they need to catch up as well, and I'm sure they will eventually. I really believe that we need to be advocating for thoughtful regulation that addresses systemic risks, more than just consumer protection, because I think it's the systemic risks that make this a different beast. But if we get a solid regulatory framework that let's say limits what assets can back stable coins, requires certain disclosures, and monitors large stablecoin issuers for systemic importance, I think that could actually stabilize the environment and make it safer for serious institutional involvement. If you are in NED or in an oversight function, I think one of the most powerful things that you can do is to ask management the hard questions that really test whether they have thought through those second and third order consequences. I mean, it's very easy to get blinded by the immediate benefits, cost savings, new revenue streams, customer lock-in, etc., etc. But I think our job is to be the voice in the room that's saying, have we truly assessed the antitrust and competitive risks of supporting business models that create captive monetary systems? What governance frameworks do we have in place to ensure that our investments in corporate stablecoin systems don't inadvertently support financial surveillance capabilities that could harm consumer privacy or create unfair competitive advantages? Have we actually modeled scenarios where multiple corporate stablecoin issuers simultaneously face redemption pressure while also needing to liquidate backing assets for their own operational reasons? So in closing, my aim here was not to throw cold water on the idea of corporate stablecoins. Not at all. It was to outline the GRC challenges that come with it. That's it for today. Thank you for tuning in. If you've got any questions, comments, or ideas for future episodes, please don't hesitate to reach out. And please, as always, share this episode with your network if you've enjoyed it. I'll be back next week with another fresh perspective. Until then, stay compliant.